Okay. Another issue, and this is one I've been working on this for a long time, the role of credit in macroeconomics, and that's really the topic of the next book I've written, which is coming out in April. It's not a one-word book, but it could be. And what I do is look at the overall credit dynamics for major economies in the world and say you can actually predict the financial crisis by a collapse in credit, which is what I'm showing there for America. But credit is I've always had the gut intuition that it's part of aggregate demand. It's also part of aggregate income. Now, this is ignored because neoclassicals, like Krugman, obviously, say you can forget about it because one person's asset, another person's liability, who cares? That's about as deep as Krugman gets. But post-Keynesians haven't incorporated it properly either, because they say that rather than looking at the asset as liability truism, they say expenditure is income as a truism. And therefore, where's the role for credit? I've had fairly intense conversations on this front, I think you're aware, which end up saying there's no role for credit in demand or income. But there is, and it's simple to show it. And what I'm showing here is imagine you divide the economy into three sectors, S1, S2, S3, and a banking sector with both loans, so the basic assets, liabilities, and equity view. This is looking now at as a system of an economy with three sectors, where Sector 1 spends on Sector 2 and Sector 3. So expenditure by Sector 1 and Sector 2 becomes income for Sector 2 and Sector 3. Ditto for Sector 2 and ditto for Sector 3. The bank having no role at the moment. I haven't got anything coming out of the bank. The negative sum of the diagonal is aggregate expenditure. The sum of the off-diagonal elements is aggregate income. So there's aggregate expenditure. What is it equal to? Okay. There's aggregate income. What's it equal to? That's where the idea of the identity of the two comes from. So that's a world where there's neither borrowing nor lending. What about a loanable funds world, which is the world Krugman inhabits, where you have, if Sector 1 is borrowing L dollars per year from Sector 2, then there has to be a stock of outstanding debt, capital L. And the reason Sector 2 is lending to Sector 1 is because of the interest payments that requires Sector 1 to make to Sector 2. So I can bring that onto the model and say that now Sector 2 is lending a flow to Sector 1. So that's the little l here, minus l here, plus l there. And then Sector 1 has to pay interest to Sector 2. That's rho times capital L here as a minus, and rho times capital L here as a plus. I'm not using Minsky's accounting conventions anymore. I'm just looking at positive and negative flows, decrementing the amount of money in each of those accounts. If you sum up aggregate expenditure, there's now a role for the financial flows involved. The financial flows are part of aggregate expenditure. And that's gross, by the way. If I had banks paying interest, I'd also have deposit interest times deposits, as well as loan interest times loans as part of aggregate expenditure. There's aggregate income, and of course it's the same. It includes income of the financial sector. So again, the identity is still maintained. Now the real world, endogenous money. So where you don't borrow from Sector 1 doesn't borrow from Sector 2 or Sector 3, it borrows from the bank. And Sector 1 pays interest to the banking sector. So I now have a borrowing of little L dollars per year from the banking sector and paying interest of rho times L, capital L, to the banking sector. So now I've got the banking sector involved there. If I add up aggregate expenditure, I get the flow of credit as part of aggregate expenditure. And add up aggregate income, I get the flow of credit as part of aggregate income as well. So it's completely valid to include credit as part of aggregate demand and aggregate income. And of course, aggregate capital gains as well when you include that. So this is the factor we've left out, even of post-Keynesian thinking, except implicitly in Minsky's own logic. If you read Minsky carefully, you'll see he's got a clear role for credit, but he couldn't quite articulate it to the stage where he convinced his post-Keynesian followers. So what you've got, expenditure is fundamentally monetary, and there are two sources of expenditure. Turnover of existing money, which is what all the A's, B's and C's are, and new expenditure financed one for one by debt. Because when you borrow money, you're borrowing to spend it. And using that, that's what I've done in the book, to identify the countries that I expect to have a financial crisis, because they both have high levels of private debt. So this is a level of private debt exceeding 1.5 times GDP here, and then credit being responsible for a substantial proportion of demand, over 10% of GDP equivalent for the amount of money coming from credit, and therefore very susceptible to a slowdown in the rate of growth of credit.